Hi, everyone. Welcome back to Lessons in the Lounge. My name is Vince. In this episode, I'm going to discuss law firm valuation methods. Yes, how to figure out what your law firm is worth if you want to sell it, or how to value a law firm that you want to buy. I'll discuss what factors can lead to higher or lower valuations, how to structure a deal for payment terms, and how to maximize client retention when transitioning a book of business to a new owner. So, disclaimer first, please note that I'm not a lawyer or an accountant, so I highly recommend that you seek out your own professional advice before implementing any of these practices. Over the past 3 decades, I've had the experience of buying and selling several of my own companies and also helping others to buy and sell their businesses. So I'm happy to share my knowledge of what has worked and what hasn't. So let's get into it. Putting a valuation on the law firm is quite different from valuing a typical business because much of its value is tied to the type of firm and the type of law that is practiced, the size of the firm, the principles, existing relationships, and recurring work. So unfortunately, there's no single simple valuation formula that can be used for all law firms. Before we get into the factors that will increase or decrease company values, let's discuss the most common valuation method used, and that's the earnings adjusted valuation method, or an earnings multiple. It's very straightforward. So you begin by analyzing the gross profit of the firm. Some people prefer to say EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And what you do is you make a few adjustments, such as remove the owner's salary, any personal expenses that have been processed through the firm, and any one-time expenses and non-recurring expenses that just probably won't, like I said, non-recurring, won't happen again. For the sake of clarity, I'm going to refer throughout this podcast to gross profits. I would suggest that you review the last 3 years of financial history and consider using a 3-year average to come up with an adjusted gross profit number. If you don't trust the financials, look at the last 3 years of income tax returns or ask for third-party proof such as bank statements, etc. Once you have the gross profit, now it's time to apply a multiple to that number. Based on my research of the industry, these multiples do fluctuate based on the type of law firm and the law that is practiced. If you know of any firms that have been recently sold, consider the valuations that were used in those deals. I would strongly suggest that you do some of your own research to confirm what multiples are currently being used. So the multiples that I've seen really do vary. So as an example, for small firms, I've been seeing 1 times to 2.5 times adjusted gross profits. And for the larger institutional firms, I've been seeing 3 to 6 times adjusted gross profits. So the stronger the firm, in other words, stable clients, good systems, good brand, the higher the multiple will be. Let's look at an example of how these ranges can apply to the following law firm. So you've determined that this law firm has a stable client base with some recurring revenue. It has a good systems in place with a good online presence. And both parties have decided that a multiple of 2 times adjusted gross profits is a good and fair valuation. So for this firm, let's also assume that the annual gross revenue that is generated every year is $1 million, and the adjusted gross profit is $400,000. So if we use the earnings method, it's quite simple. You take the $400,000 of gross profit, multiply times 2, and that's going to come out to $800,000 as the value of the company. You know what, you might want to look at things like work in progress or account receivable adjustments as well. And so anyway, so the final deal will look something like $400,000 up front, and I would suggest something like $400,000 paid over 3 years as an earnout and based on client retention. And you know what, back to the work in progress and the account receivables, what you could do is that these could be purchased at a discount. You know, as an example, maybe you can pay 60 to 90% of the value. or you can collect it after the sale and share it in one shape or fashion. So this is one example of how to structure the valuation, but since there's no simple formula, let's dive into several factors that will either raise or decrease the value of a law firm. First, what type of law firm would you like to acquire? And the big question is, will the client stay after the sale? This makes a huge difference to valuation, and I have some good ideas on how to help you do that. Goodwill and brand could be an important intangible premium if the firm has a great reputation, a good referral network, good location, and an online presence for ongoing new business. If you can transfer the goodwill of the firm and the firm has good brand recognition, this could be a huge value benefit of the acquisition. But you know what? Do be careful, because in small firms, the goodwill is often heavily tied to the owner, which is going to reduce value unless there's a strong transition plan that you've put in place. The other factor is you have to look at is it mostly recurring work or one-time work? So a law firm that specializes in corporate matters, such as patents, tax work, updating corporate minute books, etc., has a high likelihood of recurring revenue, whereas when you compare that to a law firm that, say, does litigation work, they would have a less likelihood of recurring revenue. So big difference between the two. The client concentration of the firm is another big factor. Does the law firm have a couple of big clients, or do they have many clients? You know what? Fewer clients could mean more risk for the buyer when it comes to client retention. Another area that you have to consider are the relationships tied to the firm or to an individual lawyer. Clients tied to an individual lawyer can also mean a higher risk for you as a buyer when it comes to client retention. So to summarize, what drives higher valuation? Recurring, predictable revenue, a diversified client base, strong associates, so not an owner-dependent firm, documented systems and processes, niche specializations, for example, a law firm that specializes in IP or healthcare, tax work or patents. And you know what? So what lowers value? Well, when the owner is the business, it's usually, or it's mostly made up of one-time transactional work. The owner has kept poor financial records. There's a high client concentration, so only a few clients. And there's a weak transition plan in place. And I'm going to talk about more of these in a moment. Let's talk about how the right deal and transition structure can help you to raise the value of the firm while improving client retention for the buyer. So you and the buyer have completed your analysis and have asked a zillion questions of each other, and you've arrived at a valuation for the business. That's great news. Now comes the terms of the deal. If I was to put myself in the buyer's position for a moment and use the example above for a law firm that is valued at $800,000, I would consider paying $400,000 at closing and $400,000 over 3 years, paid quarterly with no interest and subject to a client retention clause. A word of warning here: never overpay for the down payment, because you, as the buyer, will have less or no recourse if clients leave or the deal goes sideways for any reason. Holding the $400,000 as a holdback and earnout is a great way to ensure that the seller will help you to transition their clients over to you. Speaking of client transition, depending on how many clients must be transferred or the complexity of the transition, I would suggest a minimum transition period of 1 to 2 years. In the first year, you can consider paying the seller lawyer either a basic salary or a consulting fee to help with the transition. In the second year, when less involvement is required by the selling lawyer, consider either reducing the salary or not paying a salary at all, as the seller will still be eligible to receive quarterly payments from the sale. Another word of warning: if there's a scenario where the seller cannot help with the transition, say the seller has passed away or is ill, or can help but only for a shorter period of time, this will negatively affect the selling price. So this will make a client retention clause not only important, but an absolute must. This is a good time to jump in and discuss the client retention clause. Since no one technically owns a client and the client is free to stay or go to another law firm, it's critical to have a client retention clause in place. Here's an example of a straightforward client retention clause. However, if you're a creative thinker, you can add your own improvements and changes to it. Let's assume once again that the firm you're buying has an average of $1 million of gross revenue with an adjusted gross profit of $400,000. You've decided on a valuation of $800,000 with a $400,000 down payment on closing. The remaining $400,000 earnout will be paid on a quarterly basis in equal installments of $33,333. And that would be subject to a client retention clause. Let's call this the budgeted earnout that the seller hopes to receive if 100% of the client revenue stays. In this agreement, the seller has to agree to a specific period of time to transition the clients over to you, and the seller has agreed to sign a non-solicitation and a non-deal agreement. So looking at the following illustration, you'll notice that I'm referring to baseline revenue as meaning the $250,000 of expected quarterly revenue. In other words, the seller will receive the full quarterly payment of $33,333 if the transferred clients generate at least $250,000 of gross revenue in the previous quarter. Collected revenue means the actual revenue that the buyer has collected during the applicable quarter from the clients of the purchased business. At the end of each quarter, you as the buyer would calculate the collected revenue that you've received, perform a very simple calculation, as you can see at the bottom of the spreadsheet. Collected revenue is first divided by the baseline number and then multiplied by the budget earnout number. This will give you the actual earnout for that quarter that you'll pay to the seller based on the past quarter's retained revenue or collected revenue. It's that simple. You'll notice that if the collected revenue equals the baseline revenue, the seller will receive his or her full earnout. But if the collected revenue fluctuates, as I've shown on the screen, the seller's earnout will be reduced. Oh, and by the way, if the collected revenue exceeds the baseline revenue, the excess over the baseline revenue is not counted. And so for the sake of this calculation, the buyer would never pay more than the budgeted earnout of $33,333. You know, a seller may argue that the timing of revenue could inadvertently reduce the quarterly earnout, and that's a fair concern. So you can do a couple of things. One is you can agree that any work in progress or account receivable that is delayed and hasn't been collected can be included in the collected revenue for that quarter. Secondly, you can say that if the collected revenue is greater than, say, 90% or 95%, then the full earnout will be paid. So you do have options. To ensure fairness for both parties, I would suggest that the buyer keeps a very good record of the collected revenue so that both parties can do an annual reconciliation at year end to account for timing differences, underpayments, or overpayments. Let's move on to a different topic. Should you buy just the assets of the firm, or should you buy shares of an incorporated law practice? I would strongly suggest that you purchase the assets of the firm rather than the shares of an incorporated law practice to avoid any future and unknown liabilities. For more information on the differences of an asset purchase versus a share purchase, please refer to my video that is called Asset Purchase versus a Share Purchase. Let's talk about employees for a moment. If the selling law firm has employees that you believe would be key employees to help you retain the clients, you'll want to decide if you'll hire these key employees. If you're buying assets of the firm rather than shares of the firm, the seller will have to be in a position where they will have to terminate that employee, pay the applicable severance for the years of service, and only after that's done can you rehire that employee. So you know what? That's it for today. I hope that this information has been helpful, and I would welcome any comments that you may have. If you've enjoyed this episode, please be sure to subscribe to the channel and please give me a like. Until next time, think long term.